What's up, everyone? Let's do some, due diligence, or let's do some research. See if we could find some good picks for tomorrow. I think if you, in a short term, if you make a lot of money, like on an investment, I think it's generally luck. I don't think many people can say, I knew for a fact this stock will go up or go down in the 24-hour period or 1 week period I purchased it. You might have a hunch and you get lucky. Unless you have insider information, I don't see how it's possible to really know. Quags, what's up? Yeah, I guess throw out some tickers. I don't know if you can tell, but I put padding around my room. And I think it kind of like absorbs the noise. So there's less echo. I don't know. But the cost of the padding, and I added some carpet. Well, not carpet, I bought rugs. It's about 1 year of YouTube revenue. So for an entire year of revenue, I bought this padding. So that either implies I bought really, really expensive padding and rugs, or I make very, very little on a YouTube channel. And it's not expensive. I actually look for inexpensive products. So I make like $250 a month, maybe lately, in YouTube earnings. So it's about $3,000 a year. So I spent about $2,000. So maybe 10 months of YouTube earnings. $2,000 on the padding. I mean, it's just a hobby, YouTube thing. It's not doesn't pay any bills. There was a time I was making like it was just like a 3-month period. I made like $1,500 or $2,000 a month. Yeah, it should deaden the sound a bit, or if you still have problems, put bass traps in the corners. That helps big time with the reverb. I think it helps. I don't know if you guys can tell, but even if I get the best equipment, the best microphone, the best computer, that doesn't make up for my lack of personality. I'm not really super outgoing, and hey, David, what's up? But, everybody's different, right? Pull buddy's perfect. So what do you guys think about tomorrow? Are there any good kind of stocks we should look at? Any $250 would pay my bills. $250 a month would pay your bills? Really? You must not live in the United States. Unless you live at home with your parents, then I guess $250 might pay your bills. Bass, like the basis, not base. I said bass, right? So don't put fish in my room. No fish, but instruments. Got it. I mean, my expenses are extremely low, and I live in the Bay Area because I paid off my house, so I don't have a mortgage anymore. I don't pay rent, but still, just to like cover my day-to-day expenses, like medical. Well, I have a job now, so I guess I don't need to pay for medical anymore. It comes out of my paycheck, but it's like I need $3,000 a month just to cover my day-to-day expenses. That's not a lot of money. I live in a really expensive area too, and I managed to get it down to $3,000 a month. Oh, you're in Southern California? I mean, because just my taxes alone on my house are like $1,500 a month. And when I didn't work, I had to pay. It was $1,200 for medical for me and my wife. Now it's probably like $1,600 a month, $1,700 a month, because it's gone up. So at $3,000 a month is just ridiculously cheap. That's not doing anything, no vacations. That's assuming I don't have any extra expenses, because sometimes things go wrong. Like, something needs to get fixed. Like you have a leak in the plumbing, so you can need a plumber. Sometimes your car breaks down, things like that. So I'm not assuming all those things. I'm assuming nothing goes wrong. Everything's perfect. Medical is just ridiculous. It's the most overpriced. And it's not like that in other countries. Other countries, they seem to have it under control. In some countries, it's actually everybody gets a free medical. Well, not free, but they don't pay for it. They pay for it through taxes, of course, but medical is the reason a lot of people aren't entrepreneurs. That was the biggest hurdle for when I had my own business. Like sometimes just the medical, it was so expensive just to pay the minimum premium. It just was like, even if I didn't make much money at my company, I was dishing out $25,000 a year in medical insurance. And what if I need to go to the doctor? I try to avoid the doctor because if you go to the doctor, then you got to pay another few $100s. So yeah, but yeah, what stocks? What do you guys think? I just can't grow my channel like I used to. It sucks. I want to get to 40,000 subs so I could do my subscriber portfolio reveal. It's like a year and a half since I was at 30,000 subs. And I was growing 10,000 subs about every 6 months in my heyday. I went from 0 to 10, 10 to 20, 20 to 30. Now 30 to 40, it's been like a year and a half, and I'm still not at 40. But you don't want to hear about that. You want to talk about stocks, right? I started an HSA years ago to get ready for my future medical bills. I can't believe how expensive. Yeah, I know. Even if you try to save money on those types of things, it's just like, I remember when I had a job in New York and I would like take money out from my 401k. I would invest into the company stock, the employee stock purchase plan. And I was only making like 40% of my pay. I was like, I only got 40% of my gross pay. 35% went to taxes, then all these other things. I had to wait to the end of the year just to make money when I get my tax return. No echo, right? It's great, right? No echo. So what's the Nvidia? Has anybody lost on Nvidia? I think of Nvidia like I think of Trump. Remember when Trump got elected for the first time, 2016? Because 2020 is, we always have a new president every leap year, or at least we vote for a president every leap year. They don't actually take office till the following year. 2020, we elected Biden. He didn't technically take office till I think January 2021, but so every leap year we vote for a president. This year, I don't know, but yeah, I think of Trump like I think of Nvidia. When people were when Trump got elected, people were saying, "I hope the U.S. Falls and crumbles. I hope we lose a lot of money. I hope crime goes up." They were hoping all these bad things happen because of Trump as being president. It's like, in order for people to feel satisfied, to feel like they're right, they want Trump to really struggle. But that doesn't make sense. It's like you hope your country does poorly because you don't like the president. That's like I feel with the Nvidia. Nvidia, like when it goes down a lot, I feel vindicated. Like, yes, it's going down, Nvidia. I feel smart. I feel like because I avoided Nvidia thinking it was overvalued. And then when Nvidia goes up, I'm upset. I'm like, oh, damn it. I should have invested in Nvidia. But I hold so much Nvidia already in my S&P 500 and I own other indexes and ETFs. And the main weight of it is Nvidia. So it's like I'm hoping to lose money. It's like right when Trump became president, people were hoping the U.S. would do poorly. Like, it doesn't make sense. Just because there's one person or one actor in the entire equation, you hope for bad things to happen to yourself. I own Nvidia's ETS, too expensive for the moment. A lot of people are down. Generally, when the stocks, when a company grows a lot and becomes a really big, successful company, it opens a door for a lot of people to lose money. Because it's kind of like Bitcoin's a good example. Like Bitcoin, you know, the number of people, you know, there might have been like 100,000 people that got into Bitcoin early, like pre-$100 levels. Like they owned Bitcoin way before everybody else knew about it. Or even when it was starting to get a little hype, and they accumulated more of it. And then when it goes really high in price, like this is the number of people. And they own like 90% of the Bitcoin, these 100,000 people. But as it goes higher and higher in price, then you have like, you know, 10 million people who start buying Bitcoin. They don't buy as much as these first 100,000 people. These first 100,000 people own a lot of Bitcoin, but then there's like so many millions of people who buy like $1,000 of Bitcoin, or even a few $100s of Bitcoin, or some people actually put a lot of money in, like $50,000 of Bitcoin. And most of those people are down. So a majority of people lose money in investments because it's the early people, the people got in early on the investment, are making all the money. Even if Bitcoin goes down to 10,000, the early people are still going to be up a lot. It's the mass amounts of people are down. So the number of people that are losing money on Nvidia is higher than the people who made money on Nvidia. I'm talking about individuals, because a lot of small investors tend to buy things when they're really high. And a small subset of people accumulated a lot of it when it was really low. And they're going to hold for a long time, and they're always going to be up on their investments. What's going on? Oh, okay. So yeah, as it runs up, Nvidia, more people start jumping into it. And then a lot of people bought it north of 100. And it might get back up to 100, and it's at 113. How about Amazon went all in recently for long term? I think Amazon is a really great way. Like they have such a. I mean, I wonder why Yahoo Finance doesn't show charts anymore. They have such potential because they control so much. They control. They're like 40% of the cloud computing market. So if a company like Nvidia can hit 3 trillion, a company like Amazon should easily hit 5-6 trillion. And don't fall into the trap saying it's too expensive. You know, it's almost 2 trillion market cap, therefore it can't go up. Just look at the valuation. Don't look at how much it costs. How much it costs is irrelevant. Because if I say buy this thing for $1,000, but I have to tell you what you're buying. And if I say it's a dozen eggs, you're going to be like, why would I spend $1,000 when I could just go to the store and spend $4, $5, $6? And then if I say it's a brand new Tesla, so that $1,000 for a brand new Tesla is an amazing deal. For eggs, it's a terrible deal. So let's find out what we're getting for the investment for the 1.9 trillion. Let's not just assume it's 1.9 trillion, therefore it's overpriced. But I think that they have a really strong future because things like AI, which I don't think is the greatest thing in the world, but it is pushing stocks up, and other things, we're getting closer to moving a lot. Like a lot of people buy online, and a lot more will continue to buy online, and they just control online retail. So, and that's not going away, and they just have so much power in these positions. But you see, it's kind of like a lost leader. Online retail. I don't think they make much money. They make money from online retail, but the margins are so slim. But they make a ton of money in cloud computing, like an unbelievable amount of money in cloud computing. So I'm at 160. But that's assuming they're going to grow at this level. I think there's a good chance they'll be even higher, like 150 billion of free cash flow. If not in 3 years from now, maybe in 4 or 5 years from now. Because the reason I think Amazon is kind of like a lock is we can't get away from buying things. We have to buy things. We need to live. We need. It's not even for like, you buy like a sporting equipment because you play sports, but some things you need to buy to live. Like you buy things all the time. You buy like toothpaste, stuff like that. So you can't get away from it. But like, if you buy a product, a company that sells a product, like Apple sells the iPhone, which has extreme power, because so many people love it. But things could change, and I don't think they will. I think Apple will be dominant, but it's possible people will move away because there was like the flip phone, Nokia, and people moved away from that. Even though they loved it, they found a better product than Apple. So things change. But in terms of like online retail, you can't really change that. You might, the person selling the product, like the supermarket down the road, everybody goes to a supermarket that lives in that town because some people eat out a lot, but you can't eat out every single night. And even if you do eat out most nights, you still sometimes have to buy things from the supermarket. So that's always going to have demand. Supermarkets always going to be demand there. But it's who's the supermarket? Which supermarket's gonna get the customers? That's what we have to figure out. Whirlpool is gonna get the business. MicroStrategy. Not sure if we discussed them. Thanks. Do you guys look at a 10K or 10Q? I find it easier than looking at the presentations. I have a hard time getting all the information from those like PowerPoint slides. Okay, so I think you should focus on operating income if you want to look at the income statement. Because the stuff below operating income is kind of just noise. You really and it could kind of skew your oh my God. What do you guys think of Amazon? Do you guys notice the background? Does it seem better or This is what I like to do when I look at a company. Well, I want to find out how they make money, and then I want to figure out their margins, how profitable they are. I think that's the two most important things. If you're looking at a company, say you wanted to buy a small business, there's a million things that are important. I get that, but if you want to buy a business or invest in a business, finding out how they make money and their margins, what their expenses are relative to that. Other things, there's a lot of noise going on, like how much debt they have, the interest rate they pay on the debt, whether they have high inventory, low inventory. There's valid reasons to look at it, but it get real confusing. So just try to stick to the basics. Let's see how they make money, and let's see their margins, their profit. Yeah, I love Amazon. It's so and you deliver Amazon, right? Isn't that? So this is they provide pretty good detail here. They break down their revenue and operating income by segment. So that gives you exactly what you need. Because if you were to buy a small business, you would ask the owner, like, how much money are you making? What are your sales? What are how high is payroll? And this would help you make a decision if you wanted to buy it, and how much you want to pay for it. And then you could argue. You could say, well, you're only profiting $60,000 a year, and your expenses are really low in this category. If I took the business over, I'd have to be spending more money than you are, so I wouldn't make as much. So therefore, I don't want to buy it for $100,000. I think $70,000 is a better offer, and then you would obviously negotiate. Okay, so this gives us so these two charts will give us a pretty good view. So this is the first quarter of 2024. They do it backwards. Sales 140 billion. Expenses 128 billion. So operating income 15 billion. So if we were to buy this business, you always assume when you look at a stock, you're going to buy the entire company as a whole. You can't say, well, I'm going to own 1/1,000,000th of the stock. So if I own one share, I own, 1 out of 50 billion or whatever. And then you can't do that. It would take forever. So just assume you're going to buy the entire company and then decide if you want to buy it or not. So you can see, this is what I mean. Their sales, their online, the retail sales, when you go to Amazon website and buying a product from Amazon, it's 77 billion of revenue from selling products on their website. There's other things baked into this, but that's, I think, the majority. Probably 95% of the revenue is the online retail sales. And they have a lot of expenses that go along with that. 76 billion of expenses. So you can see what I'm saying. It's like a break-even proposition. Like eBay is strictly online e-commerce. So their margins are slim, like Amazon. Amazon is actually losing money because they, in their international segment, they have an operating loss of 1.2 billion. So an international, 29 billion of revenue, a loss. And that loss is higher than the profit in North America. So they're losing money in e-commerce. So why is it good investment? Because look, this is where they make all the money right here. Amazon Web Services. That's pretty good margins. 21,534 of revenue. operating income. So 24% operating margin. So that's a good margin. I mean, if this was Nvidia, their operating margins are like 60, 70%. But it's a different company, a different business. And they could scale much more because they support all the cloud computing. Anybody that has a website, anybody that and how many websites are there, that use Amazon Web Services or need some type of cloud computing support? There's so many websites. How many people need semiconductor chips? A lot of people do, but not as many as the demand for websites. Let's see. Cloud computing market share. They're definitely number one. I don't know if who's maybe. Oh, this is updated. So they're 31% of the cloud market, Amazon. Microsoft Azure is 25% of the cloud computing market. And Google is 11%. But even if you're like a Salesforce with 3%, still 3% of a $76 billion market is pretty big. And Salesforce is actually a pretty good sized company. They're nowhere near the size of Amazon, but they're probably like a couple $100 billion, 250 billion market cap. So it's a good sized company. So that's what I'm saying. That's where they make all their money is cloud computing. They don't even make money in the other markets. But these are operating results, net income. Expenses are dragged down by depreciation. So if you look on a cash basis, they're cash flow positive, even in e-commerce. I wish they would break it down, the cash flows by segment. So yeah, operating cash flow for 2024. Look at that, 19 billion. It was 5 billion last year. So this is what, if you want to like learn about like what company to invest in, look at operating cash flow, because that kind of eliminates all the noise and headache of all these accounting things going on the income statement. It's actual cash. So they generate 19 billion of cash for the first quarter, which is more than triple last year. And for the trailing 12 months, it's nearly 100 billion, double last year. So it doesn't matter if they're even breaking even on the e-commerce business. They're making so much money in cloud that it's fine. And I don't think they're breaking even. Like I said, if you strip out things like depreciation and other non-cash items, they're doing fine. What do you think of WNC? It's a solid small cap, in my opinion. Like to know WNC. I might have done a video on WNC. Sounds familiar. Maybe not. Thought I did. So WNC, $21. Not too small, but it's pretty close to $1 billion. I say like stick to $1 billion or higher. When you get real low, like those $200 million market cap companies, it's pretty risky stuff. WNC. They do have positive free cash flow. That's good. The forecast isn't too high. So I'm at $1 where they're trading at, ironically. But let's. So the first thing I like to do before I get into the financials, just understand what they do. Wikipedia I like because Wikipedia kind of is more straightforward. It doesn't there's not too much like excess stuff going on. Okay, Wabash manufacturing company, largest producer of semis. Oh, I think I remember that from a video I did. So what do you guys think of? You can see the padding, right? It sounds better, right? Less noise pollution. Because the stock market is perfectly efficient. All information is priced into the stock. So it's impossible to make money in the stock market unless you have inside information. Or I said you get really lucky. So when you invest in a perfectly efficient stock market, like our market, you've heard the EMH. The efficient market hypothesis. I don't know if you guys, I guess economics, right? That's where they would teach this. And I do believe this. It's a theory that shares a theory that states that share prices reflect all information. So all the possible information there is out there, everybody has access to that information, right? Like if a company goes bankrupt, everybody knows that. That information is public. Maybe not everybody knows it, but everybody has access to that information. Or if what did I just do a video on? Intel. Intel used to supply all the chips for iPhones. Apple would use Intel exclusively for the chips, the semiconductor chips to put into the iPhone. And then in 2020, Apple said they're going to start making their own chips. Not into the Mac computers, Apple's Mac computers, not the iPhones. So the Mac transitioned to Intel processors. I can't remember where. Well, let me show you. Scott is Wikipedia. I don't want to get the dates wrong. Okay. So for a long time, like 10, 15 years, Apple would buy semiconductor chips from Intel to put into their Mac computers. So that was a great customer. That was like their main customer, Intel. And then Apple said, we're going to make our own chips. So in 2020, Apple severed their relationship with Intel, and they wanted to keep it in-house, what you call vertically integrated. So that was a big hit to Intel. That their biggest customer they lost. And if you look at Intel's if you look at Intel's revenue, you can see where they've been suffering. Because Intel, up through 2023, they generated more revenue than any other semiconductor company. In 2023, they were still generating more than Nvidia. And you can see it peaked in 2020 at 80 billion. And then in 2021, it was still 80 billion. But the loss of Apple brought it way down to 50 billion. And they've been like losing a lot of market share, but finally it's come up. The past quarter, revenue is up for the trailing 12 months for like the first time in a while. It went from 54 billion to 55 billion. It's not a big jump, but at least it's up. It's not going down. And that's why the stock came down so much. So this is what I'm saying. Like, if Intel loses their biggest customer, Apple, Intel stock will go down a lot. And everybody has all this information. So everything's priced in. So there's really no value in trying to like figure out what's undervalued, what's overvalued, because all the information is already priced in. You're just wasting your time. So our job, I guess, is to figure out the future. Like, will Wabash, how will they be in the future? What is the demand for semis? Will demand for semis go up? If it does go up, pretty much all companies in this industry will make money. And if demand goes down, then companies like this will start to struggle. But it's possible demand is flat and this stock goes up a lot because it takes market share from other companies. So you think Intel, when that chip factory, because Intel is really Intel is both a fabless and a foundry. So fabless is like Nvidia. they just design the semiconductor chips, and then they let somebody manufacture them. Like Taiwan Semi is a foundry. They're the largest foundry. They've been the largest foundry forever, and they will always be the largest foundry. Fabless changes. So Intel was the largest fabless company for a long time. Now Nvidia is, and I think Nvidia will probably be the largest for a long time, but it changes a lot. It's a cyclical industry, semiconductors. On the other hand, Intel is now trying to be a foundry in addition to a fabless. So they're trying to manufacture semiconductor chips, mostly in the United States. Half their manufacturing capacity is in the US. They also manufacture in China, in Taiwan, in China, and Israel. Those are the main manufacturing. They have some other countries, but mainly it's like off the top of my head, I think I would say I think half their manufacturing is in the US, roughly. Probably like 25% in China, 10%, and then I don't know the other countries because they don't list every single country, but there's probably a bunch of them that make up. Is that 100? Did I do the math right? Yeah, okay. I did the math right. So the EMH hypothesizes that stocks trade at their fair market value on exchanges, which I think is true. Proponents of EMH posit, you don't see that word too often, posit, that investors benefit from investing in a low-cost passive portfolio, like spiders, an index, because even if you listen to these investment bankers and these hedge funds who say we can beat the market, almost nobody does. So investing in like an index that holds a broad portfolio of the market is gonna 9 out of 10 times is gonna make you more money than being an active trader. It's just not much fun. So that's why I say put at least half your money in an index, whatever index you want. At least half, maybe more. The more the better, actually. If you want to put it, I'd say 90%. If you have 100K, I'd say $90,000 into like some index, spiders, and then you could trade with 10,000. Although it never works, because if you start making money, if you turn the 10,000 into like 18,000 in 6 months, you're going to start taking from the 90. And if you lose the 10,000, then you might not start trading. Proponents of the MH posit. That's how you pronounce it, right? Posit that investors benefit from investing in low-cost passive portfolio. Okay. Opponents of EMH believe that it is possible to beat the market and that stock can deviate from their market values. The thing with Warren Buffett, he was making amazing returns. It doesn't go back that far. I want to see Buffett's annual returns. They should have it. I don't know why I can't find it. I want to see it going back to like the 50s. I guess it doesn't matter. But he was making like a 20, 30, 40%, some years 50, 60% return on his portfolio of investments when he started Berkshire. So even if you get like I mean, it makes such a big difference. Like, say you like from 1980. So let's say you start with $10,000. And let's just say you put it into like an investment like Spiders, and you get 10% average annual return. And you retire in 2033, you have 1.6 million. But he was able to consistently beat the market. Some years he got, I wish they would show it, because maybe it's the, I think it's in one of his, maybe it's common stock information. Look at this website. It's so basic. A letter. Maybe it's in the annual letter. Here it is, right here. How come it didn't show up? Oh, because 65. It makes such a big difference. And you wouldn't think, like, if I got an 8% return and you got a 12% return, you would think, oh, okay, it's not that much different. But it really, so this is his fund, Berkshire Hathaway. This is the annual return, and this is the S&P 500. Okay, so his very first year as a fund, he didn't have much money, probably like $2 million, mostly from friends and family. But his very first year, he returned 50%. It's amazing because the market did 10%. So he got returned 50%, but that's just 1 year. But it accumulates so much. In his second year, he lost 3%, which is great because the market lost 12%. His third year, I bet you some people jump ship after the third year, because especially if you were the first time you invested in him was in 67, because he returned 13% and the market did 31%. So you're probably like, why am I paying this guy a 1% fee to not even get close to the market? But then he got 78%, the market 11%. But there's some years, like in 1970, he lost 5% and the market gained 4%. But look at this, 129%, 102%. That's just crazy, right? He averaged 20% and the market averaged 10%. So let's just say in 1980, you just put $10,000 with him, because you weren't alive in the 60s, and which isn't a lot of money, right? Because I'm not saying you're even adding to it, because a lot of us put $10,000 every single year into our retirement. So so if you invested with him in 1980, I'm assuming he did 20% from 1980 on. But I know he did 20% from 1965 on. Just $10,000. Like, okay, I didn't update. So you both have 10,000, and your friend puts 10,000 into a S&P 500. You put 10,000 into Berkshire in 1980, and you don't touch it for 50 years. Say you're 20, you're both 20. $1.5 million versus $150 million, which is a lot. But say you both retired in 2023, from 1980 to 2023. So that's 43 years. The difference between 600,000 and 25 million. I mean, if you put 10,000 a year, it would explode with a 20% annual return. The compounding, it just gets so crazy. Look at that, 157 million. You can see it really blows up when it gets to these big numbers. But my point was, he figured out the market. He figured out how to value companies before anybody else did, and he was doing it for decades. But the thing is now that a lot of people have figured it out, not just him. So you can't really beat the market. Like in the early years, he beat the market pretty consistently, but in the later years, he hasn't done as well. Although I put my money into Berkshire in 2017. I bought one A share. And I was actually, right away, he lost 4% the following year. Oh, no, sorry, this is him. He gained 3%. The market went down 4%. But in 2019, he gained 11%, while the market gained 31%. So literally from 2017 to 2020, like mid 2022 or beginning 2023, I would have been better off in the S&P 500. So I was like, damn, why can't he beat the S&P 500? I thought he's supposed to be so great. It wasn't until recently that he's now surpassed the market. So I'm up about 150% on his investment, because I invested in S&P 500 the same time I invested in his. So my S&P 500 is up like 110%. His is up 150%. So So it worked out. But the thing is, if you got in early with him, he was really crushing the market in the early years, 100%. He was really beating the market. But look at this year, 1990, he lost 23%. The market lost 3%. Look at 99, he lost 20%. The market gained 21%. But the following year, he gained 27%. The market lost 9%. The reason he lost money in 99 is because the companies, the stable companies, were doing poorly, and all the dot-coms were taking off. And he didn't invest in dot-coms. But he saved money because the next 3 years, the market went down 9%, 12%, then 22%. And in those 3 years, he did really well. In those 3 years, he was up. He only had one negative year in those 3. But the market has adjusted. People have a lot more information, and you're not going to do as well with him as you would have early on. He'll still beat the market, but he won't crush the market. Like you could see, he's crushing the market even in 1997, 30 years. 50,000 versus 220,000. Because the market is much more efficient. Okay. I really get off on tangents. So let's go back to Wabash. So they manufacture semi-trailers and liquid transportation systems. Liquid transportation systems are, I guess, trucks, right? Or cars. Those are liquid, like ice cars. Not Tesla is not liquid transportation. They use EVs. I don't know why it's so slow. Okay. What is the liquid form of transportation system? Intermediate bulk containers. These reusable containers can hold up to 1,000. Liquid transportation systems are structures that facilitate the movement of water via. I never saw that term before, liquid transportation. Okay, let's just go back to it. They specialize in the production of dry freight vans, refrigerator vans, platform trailers, liquid tank trailers, intermodal equipment, engineered products. Its products are sold under the following names: Wabash, Transcraft. So they sell trans products too. Because sometimes people don't want a straight product; they want a trans. Like if you want to buy a truck, and you're LGBTQ, you're pro LGBTQ, you might go for a Transcraft. Benson, I've heard of Benson. Okay, so this gives us an idea. Now we know what they do, right? There's no questioning it. Wabash National. So now let's get their investor slides, because we already valued them at $1. So if you're going to do a quick DCF, you'd want it undervalued. You want it undervalued, but at least it's not overvalued. So we can move forward the process to get a little more information, because now we're kind of on the fence. We're not saying it's a great buy, but let's learn more about the company. If it was really overvalued, we might just move on to the next thing. Anybody familiar with Wabash? It's not a big company, so probably nobody else is familiar except who recommended it? Was it Neil? This doesn't matter. Okay, Wabash. I mean, you could spend like the rest of your life trying to analyze a company, but I just try to spend 15 minutes to get a sense of where they're at. And this will give me enough information. Like I said, just look at the income statement up through operating income. The rest is just noise. Come on. Let's see how to make money. So revenue is down. It was 700 million. Now it's 550 million. I mean, they only have $1 billion market cap. So it's a pretty good price sales ratio. Positive operating income. You want to make sure operating income is positive. If anybody wants me to do a DCF like this, leave a comment. Let's see how they generate revenue. Because if you were, say you were doing an analysis and it was the year 1999, and you saw half their revenue was from like VCRs, then you might say to yourself, well, that's kind of an obsolete product. Most people aren't buying VCRs anymore. In 1990, that was a great product. 1980, a great product. A lot of people buying VCRs. So here they give an external customers into segment. Let's see how they make money. Oh, how they generate revenue. Actually, maybe the next one's better. So here's a breakdown of the 550 million. Most of it is transportation solutions. So I guess the actual conveyance. 500 million, 50 million parts. Trailers, I guess these are in thousands, the units. Net sales, I don't know if it's in thousands or actual. So 9,000 trailers. Let's see. So 13,500 million. Let's see if that makes sense. Okay, so that does make sense. So if they sold 13,000 like vehicles, I guess trailers or trucks, and they made $500 million of revenue, that's $38,000 each. So that makes sense. Sounds a little low, $38,000 for a trailer or a truck. D's. Dex, stop joking around. D's nuts. You're always playing games. That's crazy. So 550 million of revenue. So you just want to make sure they have they're at least making money on their current business. You also want to look at competitors. If they have some real fierce competitors, it might make it hard for them to grow. I can't imagine competition being that bad. I'm sure everybody has a little piece of pie. And Mike, what's up? This is not good. They have negative operating cash flow for the first 6 months of the year. And the reason is accounts receivables. So they sold a lot of products on credit. Accounts receivables, when you sell something but you don't get paid, you will get paid in a few months. So they extended $60 million of credit. So that's a negative. It's a cash outflow. So we should see a big cash inflow the second half of 2024. So it could be a good time to buy the stock. It could be a good swing trade, because when they report like a big positive in a cash flow, investors won't realize it's not because they're selling more. It's just because they got paid on things they sold in the first half of 2024. But this is just noise. It doesn't take away from the fact of their actual revenues. It's just more of a timing thing, accounting. Yeah, I have a REIT valuation model. It's my it's a DCF. REITs are great for DCFs. But you want to look at FFO, funds from operations, because free cash flow sometimes for REITs isn't as reliable. Dex is always joking around. These SIB. There's no SIB stock. SOB stock with the Drill Baba by Drill Politics. SCHD. Schwab U.S. Dividend Equity ETF. So there's no noise in the background, right? So what did you guys think about that company that wants me to interview the let me get to the post, because a lot of small companies, like small cap stocks, they want exposure. They want people talking about it. Like they want people like me doing a video, or somebody, a CNN talking about it on it. They just want more people talking about it. Yeah. So a marketing company emailed me, and he said, do you want to interview the founder of Opal Capital? Opal Capital is just an RIA, registered investment advisor, or asset manager, whatever you want to call them. So they're looking for people to give them money, and they would invest, and they charge a fee, which is like such a waste. Just put it into like an index. Why do you have to pay somebody 1%, 100 basis points? You just go put it into like SCHD, and look at that, and they charge 6 basis points. SCHD. This is the difference, because say, like, we'll use this example. let's use real, because it's kind of abstract. Say it's 2024 and you're 30 years old. Say it's 2024, you're 30, and you want to put company one, it's usually 1%. Some companies charge more, like 2%. Let's just pretend it's 1%. And they usually don't even beat the market. But let's say he just does what the market does. He averages a 9% return. You give him $10,000 when you're 30, and you let it ride till you're 60, and he offers an 8% return, which I don't know why you would give him 1%, but you do. So after 30 years, you would have $100,000. Instead, if you would have invested in the market, you would have $132,000. It's not a lot of money, right? Because 30 years from now, it's probably going to be like nothing. Of course, you want to add to it each year. You want to add like, a few thousand a year, or as much as you can. But what happens often is that they don't even do that well. They ended up like with 7% return, and then you have to give them 1% on top of that. So he ends up doing a 6%, and you get 50,000 instead of 130,000. But we can add like an annual addition, like an annual 5,000 every year. But I'm just giving you an idea of. So what's the ETF? So it's DIVZ. So he has an ETF. There's $100 million invested in the ETF, which is a decent amount. I've seen a lot more, but that's not terrible. And he charges 65 basis points. So it's a lot lower than if you did a private SMA. Like if you did an SMA, separately managed account, which is a lot of people have that with their broker, then you usually get charged 1% up to 2%. But if you invest in his ETF, you pay 65 basis points. So you pay less in fees. And the reason people like his company start these ETFs is scalability. You can get a lot more people to invest because it's public. It's publicly traded. And then you take this fee. Because it's hard. It's hard for like an investment advisor to find new clients. You have to do marketing. You have to do all this. You have to build relationships and trust. It's just easier to start an ETF and just let people find it in the market. But 65 is way, it's crazy, right? Why would you pay? You're paying for their expertise. And I'm not saying they don't know what they're doing. I'm just saying they don't beat the market. That's the whole point. But yeah, I'll be right back. So see, I like what Nanalyze is doing with their like. Sometimes it's not even about making money. I mean, it should be. Some people just invest in things they feel good about. Like if there's a portfolio of companies like that are doing good things for society, people will invest in that. Some ETFs would not invest in cannabis stocks or tobacco stocks or gambling stocks because some people don't like that. I cut out. You can no. So in 2 years, Ugar invests in 4 companies only. The return does not make up for it. I'd rather put money in a growth ETF. Yeah, expense ratio is silent killer over not losing. Now the reason people put money into like they invest with somebody like an RIA, they give them money and let them invest. It's just they feel like they can't do it themselves. Because even if I tell someone just put it into the S&P index, and even if they do that, like if there's ever a downtrend, they jump ship. They sell and they're like, oh my god, I'm gonna lose all my money. So they stop. Like in 2000, I wish it was like when that crash happened in 2020. It was 222. So if you invested any time between 2017 and 2020, once the market crashed, you would have been down. So if you put money in 2017 or 2018 or 2019 or the beginning of 2020, at any point, you would have been down, possibly down a lot, like 30, 40%. If you put it in 2018, you'd be down like 10, 15%. And that's why people jump ship and they never go back. I remember a family member, they were giving $50,000. Their father gave them $50,000 and they were down to 30,000. So they sold out of it and they didn't want to go in the market. But if they would have held on, they would have tripled their money and then they would have doubled it again. A low expense. Well, VU, I think VU is lower, right? As a lower expense ratio than Spiders. VU is 3 basis points. Spiders, I think, is 4 basis points. Spiders is 9 basis points. SPLG. Oh, SPLG is also 3, you're saying? It's 2 basis points. SPLG is, and I never saw that low. FXAIX. FXAIX. I don't see an expense ratio. Maybe it's free. Oh, here it is. 1 basis point. I think that's the lowest I've ever seen. As cheap as it gets. They should pay you. I want to see an index where they pay you 1 basis point. That's Japan. They have negative inflation, deflation. So they pay you to put money into the bank. I mean, it's negative inflation. So you have to pay money to them to keep money in the bank. You don't interest in Japan. You have to pay them. Just like when oil became negative, the gas station pays you to take oil off their hands. I like eBay, but it's kind of like Amazon when we're looking at it. Like you don't make money on e-commerce. It's hard to make much money. I don't think Etsy is a great investment. It's a tough industry. E-commerce isn't that easy to make profits. I just see I see more of a timing, a value play in Etsy. I could see it going up a lot. I just don't know when. But I use eBay. I like eBay. What about Square or PayPal? Those are much better margins. Just the competition's pretty fierce in that industry. Everybody's like, everybody does like, payment transactions. There's so many companies that do it. So $79 for eBay. Simply Wall Street's 89. But like the DCF is just like one small part of investing. It's just hard to like what's the future of e-commerce and eBay? Well, e-commerce is set, right, for the future. There's going to always be demand. Okay. Oh, we never finished this. So a marketing company contacted me to interview the founder of Opal Capital. Opal Capital, he has his own ETF. Okay. DIVZ. The only reason I want to do this, not the only reason, but I just want to ask him questions. I'm not sure if he'll give straight answers, but I just want to understand like how, like mechanically, how did he get his own ETF? Like, what's the process? What does he have to do? Like obviously he has to apply somewhere and get some type of approval, but you can't just start your own ETF. Someone needs to make a good fintech ETF. Next Era Energy, he's based in Florida, and Next Era is also based in Florida. I wonder if he just has some type of contact with somebody, or relationship with. But he's but it's not his ETF. He works at another company, and I think that company started the ETF. God, why take so long? So he's a founder and chief investment officer of Opal Capital. Pretty new. It's only 2 years, right? But he's currently working at Titleist Asset Management. And that's the company that I think owns this ETF. Not him, not his company. So that's what I'm curious about that too. Like, how did he get the ETF? Like did he apply for it, or this company? I think this company applied for it. And how does it work exactly? Like the expense, it's 65 basis points. So how do they divvy out that money? Is it just like do they pay like a regular taxes on that money? And are they required to like give a certain amount to their employees, or they require, I'm just kind of mechanically like, how does that work? Yeah, he's like, exactly. He's just, well, I think he buys and sells the investments from the ETF. But in terms of like, because it's kind of like when I had my own business, like the tutoring business, I would hire the tutors and obviously do a lot of stuff. But the tutors just went to work. I was responsible for like, paying the rent, getting the curriculum. There's a lot of things to do to operate a business. Because we can just go to, we go to E-Trade or whatever our brokerage is, and we type in the ticker and we buy it. But I'm curious, like, how does it get there in order for us to buy it? Like, what are all the steps involved? And not just setting it up for one thing, but also like, how do you manage it? How do you like buy and sell, like mechanically? I'm just kind of curious about that. You do get a fee. Was it 65? So 65 basis points. So this is how much money he has invested, 100 million. $100 million, and that's his fee. That's the annual fee. That's a pretty nice chunk of money, $600,000. But that's not his pay, obviously, because it's this company, Titleist Asset Management. They get that money, and then I guess the person who runs the company, this guy, I guess, Byron Fields, then it's his. He can do whatever he wants with the money. Obviously, a lot of it probably goes towards payroll. And but like say for instance, obviously this fund needs to do well to make money, because say he grew this guy Austin Graff, say he had a great return, a great 2024, and then the amount of people who invested in the fund doubled from 105 million to 210 million. So I don't think I'd get this type of detail, but I'll ask for it. But I would imagine Byron Fields, it's his company. So he might say to Austin, listen, it's currently at 105 million, the ETF. If you could get it to 200 million, we'll give you a $50,000 bonus. I don't know. Because if you get to 210 million, now they have 1.4 million of fees they took from the ETF. And they could do whatever they want with that money. Obviously there's things you have to pay. You have to pay your electricity bill. You have to pay taxes. So probably a third of it is going towards taxes. But it's a good way to scale and grow your business. Just start an ETF. Because to be a RIA, it could be a pain. You have to find new customers, and you could spend like hours and hours with somebody who invests like $50,000, and you would take a 1% fee, but it's not, it's a lot of work. This is real straightforward, right? So I definitely want to ask him about his investments, how does he choose these investments? I mean, it seems fine. It seemed like Next Year is a good company, Broadcom, Semiconductor company, Citigroup, Verizon, British American Tobacco. I'm surprised to see them in there, but sure, why not? They offer a great dividend. Oracle. You like Oracle? Philip Morris. Look at that, 2 tobacco stocks. So he likes tobacco stocks. And theoretically, if the fund does well, more people will invest in what's it called? DIVZ. But the name of the fund ETF is Opal Dividend Income, not Titleist. That's interesting, right? It's really annoying that Yahoo doesn't. So it looks like it was about $25 when they started the ETF. 25. That was 3 years ago, a little more than 3 years ago. So it's up like 20% in 3 years, which is, not a good return. But it pays dividends. So let's see. This is a good website to see the return because it shows you your return, assuming you reinvested the dividends. So if you put $10,000 into this stock when it started trading in January 2021, you'd have $14,000 today. A 40% return, a 10.5% annual return. So it's probably consistent with the market. If you did not reinvest the dividends, you'd have $14,000. It's a little less. Some of these are dogs. I don't like the Verizon Play. Anyone know how to turn off those annoying Kamala Harris ads? Nobody can turn those off. That's why I'm saying just start your own ETF. You're not going to actually offer an ETF, but start your own. Buy the stocks you want to buy. There's no benefit of investing in stuff like this. People feel, this person has so much knowledge about the market. he's going to do great. I'm going to put all my money with him. And I'm sure if you're friends with this person or family member, you probably like really trust them. So a lot of people put their money with these. I just don't see a benefit, you know. I'm doing like, you know, I'm up like 120% in the past year. And since 2021, I'm probably up. I don't know. I took a big dip in 2022, but I'm probably up like 70, 80% since 2021. But I'm up like almost 150% in the past year because I'm at it, really. That went up like 400%. What about LW and EW and I'd like to start my own ETF, but I need all the series. Like I think I need like a series 763, and I never got those. So I mean, if I worked at an investment firm with the opportunity to start my own ETF, I guess I would get those series and stuff like that. But I'm not that interested in like working and doing those things. That's why I don't charge anything. I don't charge like a, you know, give me $10 a month and I'll, you know, you can use my DCF model and calculate, or I mean, you can be a member of the channel and for like $1, or you can donate money, of course, but I'm not going to charge for my services because it's stupid. Nobody can beat the market. If you work for Chase, I believe they pay for those. I did work for Chase, my first job out of college. I worked at Assured Guarantee. They paid for my MBA, which was awesome because that was like $70,000. Yeah, I know a lot of companies would pay for it, but I'm not in my 20s. I'm not grinding away at these. You know, I'm not interested in that. Please, I'm begging you, look at NFJ. I'm really considering buying them, but I'd like NFJ. $58, 5.3. If anybody wants to come onto the stream and co-host, you can do that. Okay, what were we doing? Oh, NFJ. Did you read that email? I posted an email somebody sent me. It's so ridiculous how they word it. It's so obvious they're not American, because nobody would ever speak this way. Permit us to commence the letter without the customary formal greeting, but using a expression of our admiration for your creative approach in crafting videos. Your remarkable work not just grabs attention, but moreover provokes thought. It sounds like Shakespeare, like trying to like use words to convey a message. It's like it's so ridiculous, right? Who like that's just such a crazy opening to an email. Permit us to commence the letter without the customary formal greeting, but using an expression of our admiration for your creative approach in crafting videos. It's like I understand what they're saying. Like I understand he's trying to say I'm gonna start like he's like saying I'm gonna start off by writing no, okay, let me start off by saying that we just want to like say how we admire your videos. Like that would be like a little more straightforward than saying permit us to commence the letter. It's just such crazy. I am Daniel, marketing manager. Okay, that's not a bad sentence. It is a little odd, but it's not terrible. The team is intrigued in the special way and your topic of your channel. That's not really English. That's not well-written English. Like no one. I don't even think that's grammatically correct. Our team are looking for partners for mutually beneficial collaboration, as well as reader increase. He wants your permission to use you. They're almost trying to get you to agree to something you haven't. No, they're not looking for my. They're just it's a scam email. It's obviously not a real person. They just use AI. But if I wanted to like scam someone, I would say like, hey Scott, I just watched one of your videos. It was really, really good. I work for a marketing company. Like that's just normal, but they just speak abstract. It's really comical. It's really weird. Yeah. Because nobody talks like this. Maybe like in the 1500s, people talk like this. Maybe. And even then, I don't think they talk like this. Like I said, if you read Shakespeare, where they try to like, instead of saying things directly, they just use these really big words. I just thought it was really funny. I get 3.5% dividend. That's a good dividend, right? With NFG. Well, Oh, look at that. I'm at 61. They're at 58. That's really close. That's interesting, right? So they do have negative free cash flow. Yeah, I like SoFi. It's been really beating down the stock. I think there's a lot of upside potential. It's just really hard to know when, because if you buy the stock and over the next 3 months it goes down 30%, it kind of sucks, right? But like that big run up, like because I was down 50%. I think I was down 70% with Meta. I bought at 330. It went down to like 90. But now I'm up like 50%. So I mean, it took 2 years of waiting. So it's just hard to know when. So it peaked 2011, 2013, 2022. National Fuel Gas Company. Okay, it's a diversified energy company with $6 billion in assets distributed among the following: exploration and production, pipeline and storage. So it's a midstream stock. Oh no, it's integrated. The utility segment sells natural gas or provides natural gas transportation services. The pipeline storage segment. Hey, Victor, what's up? Victor, I thought you had a live stream at 10 a.m. today. And I said I can't make it. And I tried to view the stream, but I didn't see it. Did I miss, did I have the wrong date or something? Yeah, Victor should hop on. Me and Victor are going to do a monthly live stream. Victor, there's a guy I work with. He does all the construction for our real estate development. He's really knowledgeable about that part of the business. I'm going to ask him if he wants to be a co-host on our first live stream. Because he really, I learned a lot from him. He really gets into the nitty gritty of how to identify a property. He's a construction manager, so he knows how to build a property from scratch. I had a podcast video conference call. I can invite you. No, Victor, I was saying I thought this morning it was 10 a.m. a live stream, but I couldn't find it. Are you saying you had a podcast, like you canceled the live stream? So yes, I'm going to ask that guy, Oscar, if he wants to be a co-host. I think it'll be really interesting to learn that side of the business, because it can help you with investing too. Because obviously, we to learn about if you want to be good at investing in REITs, you need to understand how they work, and it's not that straightforward, understanding how REITs work or anything. But to really get into the details, can be real beneficial. Because it's like investing in a Tesla. Like, who here knows how to build a car? It's really, complex stuff. But if you had someone explaining to you, how you source the materials, how you build things, and like all this stuff, like that could put you on a different level. You should be the Quags, you should be on a live stream. Oh, Victor's here. I didn't even realize. Victor.
Hey, Scott, how are you?
Good. So did I have the time wrong? It was 10 a.m.
You had the time right. Just for the podcast, what I do is I actually send out a Google Meets invitation, and then you enter into a Google Meets video conference. We talk, and then it gets recorded, and then I release it to the channel. So if you want to meet for the podcast, you go into that Google Meets meeting, we talk, and then it gets recorded.
Oh, I see. Okay, that makes sense.
It's not a live stream. It's a podcast. You record it, and then you turn it into a podcast. So.
Okay. Yeah, no, that's interesting. Yeah, so I was going to ask this guy. I'm not sure if he'd be interested, but I think he would. But some people get weird about like live streams; they don't feel comfortable.
Yeah, I can understand that. I looked at sectors, and the number one performing sector for the last month was real estate. I don't know if you started with that earlier, but it is a pretty
Yeah.
good time to look at real estate because interest rates dropped so much that it's created a big rally in real estate. So it might be really timely for him to speak.
Yeah. Real estate. The good thing about real estate is just like it's there's always going to be demand, and I know things change. Like there's always there's like topics that are real hot for a while, they go up and down, but it's kind of like it's always going to be there. You can't displace real estate. You can displace technology. It happens all the time. New products come out, and old products sometimes fade away. But you don't realize this, but the best time to buy a home is when the interest rates are high. People think the opposite. They're like, I can't afford a home because interest rates are 7%. But that's the best time to buy it because generally the higher the interest rate, interest rates move opposite the price of homes. So interest rates get really high, it's cheaper to buy homes. And when interest rates get real low, home prices start going up.
And you can buy when interest rates are high and then later on refinance. And
you can always refinance. So if interest rates, you have a high rate, you can refinance for a lower rate, but you can't refinance. If you have a low rate, you can't refinance for lower. Unless, of course. I remember when I had a 4% and I'm like, I'll never beat that. And then it got down to like below 3%.
Yeah. I got 2.5%. I forgot which year, but 2.5% on my mortgage.
2.5%. That's a fixed 2.5%?
That's a fixed 2.5%, 15 years. And I did a little arbitrage, amateur arbitrage. So I could really have paid off my home, but I'm like, okay, I'll pull 300 grand out at 2.5%. And now I earn 5 to 6% on bonds on that 300 grand. So I get a free 3% on 500 grand after my expenses.
You're a lot smarter than me. Yeah, I should have did that. I'm an idiot and I paid off my home. I could have been making an extra probably $10,000 a year on damn, that was bad. But there's no guaranteed investment, even though bonds are paying. Because you're getting, you said 5% on a bond.
So I took basically my home. I'm in Southern California, and you're in California too, so home prices are high. And interest rates got so low that I refinanced. Then I pulled 300 grand out at 2.5%. So then I was given 300 grand. Okay, great. So then I put that money in fixed income because I don't want to gamble with it. So boom, I'm making well north of 5% on bonds because bonds are paying more than 5% now. So I would safely say I'm making more than 3% on that money. So they just on that differential, it's 15 grand a year. I would probably say that I'm making more like 18 grand a year on that money.
Well, if you're paying $7,500 on a 2.5%, and you receive $15,000, I'm assuming you get 5% on that. But you said it might be higher.
Yeah,
so you make $7,500 profit.
That's consistent example there. So it's $7,500 a year, right, for a while, and it just felt like, man, that's an opportunity. So, take a vacation. Well, first I could save the money, or I could take a vacation for free, or, you can do a lot of stuff with $7,500.
But you can, you might make more. Are you doing like a money market thing?
No, I bought individual bonds, and I mean, some of my bonds are doing 11, 12%. Some bonds are doing 5.5%, mostly corporate bonds. So that's what I took the money towards. And that money went exclusively into bonds because I didn't want to have another 2022 come around. I'm like, I started with 300 grand. Now I have 200 grand. Most of my other money in stocks and a little bit of crypto.
Because at one point, mortgage rates were like 20%. And
yeah, in the 80s, in the early 80s, you were like 18%
18%,
interest. Crazy.
which is just, could you imagine? But there were people, obviously, a long time ago. But I remember my teacher saying, people were taking from their mortgage, a few $100,000 and locking in 15, 16, 17%. And they were just made a ton of money. But that's never going to happen again for the rest of our lives, I don't think.
Yeah, I think you're right.
And that's pretty much what you did.
So one thing that, I think if you look at that era, right, of high interest rates, in that era, bonds actually outperformed stocks, which was very rare.
Yeah.
And it kind of set up a lot of bad advice, so to speak. When I graduated college in 94, the advice, you remember the old 60-40 rule, or take your age, take 100 minus your age, and you should be in bonds at your, equivalent to your age and percentage. All that came out of this high interest rate period, but it was bad advice. It was like, I'm glad I always saved up and I, bought stocks and bonds. But about 5 years ago, I was 0% into bonds because they were so terrible.
Yeah.
And I look back and I'm like, I wish it would have been 100% stocks for the last 30 years. Hindsight's 2020, but it was the bad advice I got because the people who were giving me advice lived through the 80s, and they're sitting there going, hey, at some point bonds are going to start rallying again, and we're going to be making 12% on bonds again, which is great. And it's like, that never came back.
I know. I all these times, I look back and I'm like, wow, I wasted like 10 years. I could have done this and this. It's always like that. It's like, before you know it, you just got to live your life, I guess. You can't make the perfect decision in every situation. You look back like, why did I marry this person? There's always going to be like things that are, you did well, as long as you're kind of like, if you can't afford to eat, that's a problem. But we're all probably doing pretty well considering.
Yeah, for me, it's not a regret, but I would say that, I've got a 20-year-old son, 24-year-old son. And if somebody in their 20s asked, how should I save my money up? I would tell them 100% of the time, go into growth stocks. Try to find stocks that are like winners. Like I hear SoFi. I mean, that's not a bad investment for a young person. Diversify. Don't just go into one stock. But I would say you go 100% stocks. Go into 100% things that are going to grow. They're going to double every 5 years or so. You don't need bonds right now. When you're older, I'm 55, so now I need bonds, so I'm buying bonds. But don't worry about bonds for now.
Yeah, I'm 100%. I did have a bond, but it matured, I think, a year or two ago after like 5 years. And then didn't buy another bond. But, everybody, that's why people get investment advisors, because they would keep questioning. Like, I'm back. Can you hear me?
Yeah, we left you, or we lost you for like 20 seconds or so.
Yeah, I saw that. Yeah, I don't know what that happens, but what was I saying? I can't remember what I was saying now. Yeah, SoFi. I don't know. Do you like SoFi?
I think conceptually it's a new idea. I would just say that fintech finance is a bit crowded. It just seems to be kind of a crowded marketplace. If I were 20 years old, 24 years old, I'd really want to learn like biotech. If you find the right biotech company, like UTHR is pretty exciting. It's one of the investments I'm going into. Or find a technology company that's doing something, outside of finance. Like find the next Uber, find the next Google, right? Find the next Meta, find the next, like ChatGPT. That's a very recent, like just explosive value. If you can find a couple of those and you invest in them when you're 20, you're going to make millions over your lifetime if you stick to that investment. So I would say SoFi is interesting, but I don't know that SoFi is going to be worth $1 trillion. But I can tell you, some companies in technology like ChatGPT, it's easy to say that's probably going to be worth $1 trillion someday. So let's find the next ChatGPT. So if you're young, try to get smart around finding the next Meta, Google, Microsoft. Try to find that next company that's just going to be massive. And if you invest early and you stick to it, you're going to be set.
Yeah, I know it's so hard. Like, and I remember like I had a plan, like I'm going to buy this stock and sit and hold. But then I don't know what happened, but I didn't stick to that plan. And then, and it would have worked out. So what, like, it's just like, because things change in your life. And then, especially if you own a stock for just a few months, sometimes you start questioning it. You're like, oh, I hear negative news. So it gets in your head. And then you're like, I'm not going to buy it anymore. And then, but yeah. If you can stick to your plan, but it's hard because like, it's kind of like working out. Like we know we should work out. So it's not like if you were to gain weight, it's not like, okay, the reason I'm gaining weight is from the working out. Like, working out's good. We fall off the wagon, we have to get back on. But investing is different because you're like, you should invest, but then you start to lose faith in a company for whatever reason. And I started getting close to losing faith in Meta when they fell below 100. I didn't sell.
I was there. I was right there with you. I was already subscribed to your channel.
Yeah.
In 22, right? One lesson out of that is, Warren Buffett, he said, 1,000 things that are really wise. And one of the things is that if you can't get your emotional, stability and strength established and strong, you should invest in stocks. And 22 really was the last really good test of you got to stay strong. If anything, you got to follow the principles that you believe in and ignore the emotion. Like everybody was bad mouthing Meta. Zuckerberg's an idiot. The metaverse is the worst idea that's ever come out, and yada, yada. You look at their cash flow, you're sitting there looking at a cash generating machine in Meta. So I did buy in 22. I wish I would have bought twice as much, but I did buy, and I bought good amounts. And like you, benefited from the rise of Meta. So it was a good lesson of there'll be another time like that. Last week was a little taste test of what could be, if we prolong last week into like, let's say 3 months or 6 months, it gets pretty darn exhausting of seeing your stock go from 100 to 50.
Yeah.
So this here, tough. You're looking at SoFi. Okay, cool.
What was I gonna? Oh, when I started adding into videos, I don't know if this is gonna get much action, but I'm starting to go through some of the rate reviews. So the video I just did, it was on the company on Semiconductor. They're a small semiconductor company, I think like 20 billion market cap.
Yep.
But I went through the reviews of employees, what employees said about working there, and also reviews on Yahoo Finance, what people investing say. I think it's interesting because if you read employee reviews of the company, you get some insight into, obviously you're getting insight into working there, and you might get some insight into like the company. I think it's the thoughts on Galway Metals. I think it's the best risk reward in the market. Wow, in the whole market. Galway. These junior miners are really a dime a dozen, because 27 million market cap. So a junior miner is generally not this small. Lots of junior miners are like 100 to 300 million market cap, and all the value is on if they can identify a location that has gold or oil or whatever commodity they're looking for. And 99% of the time they don't identify anything, and the company goes bankrupt.
Yeah, and even if they're successful, right? Like these companies, just based on industry and sector, investors are not going to like go. They're not going to like bring up the value of the company up to its intrinsic value, because it's a mining company and they know it's very cyclical. It could be boom and bust, as opposed to other sectors like we just talked about, Meta and communication services. If you prove that you can grow and you can prove you can grow your cash flows, you're going to be worth so much money. Your company is going to be worth so much money. Or technology, right? If you're in the technology space and you can prove growth. So not all, cash flows are valued the same. It also depends on sector, and mining companies tend to be super discounted because I think the market says it's a boom and bust industry, and I don't want to buy when it's booming, and then when it goes bust, I lose a bunch of money.
Yeah. It does take a special investor, because with a junior miner, they're pre-revenue. A lot of junior miners are either pre-revenue or very little revenue, because it's the exploration part, trying to identify if there's enough of the commodity at a particular location. And obviously, even if you identify there's $50 million of gold at this location, if it costs you $100 million to extract that gold, you can't do it. There's a lot of locations. There's oil beneath the sea that's worth trillions of dollars, but it costs more money to get it. So no one's going to get it. But I don't understand. Lakers, are you promoting this company, or do you really think I don't understand. Like, I'm not trying to like put you in a hot seat, but like, why would you say it's the best risk reward in the entire market? And are you just saying that just to say it because they're pre-revenue? I mean, I could give you an example of why they might be. Like, if you did some due diligence and you identified, the locations and assets they're testing. Have you gone to that level? But I don't want to be a jerk. I'm not trying to throw you in the bus. I was just curious why you said that. Maybe you're a CEO of the company, and you're just trying to promote it. Which is the most money I made on this channel was from junior miners. Like, there was a few of them that wanted YouTubers to make videos. So they used to pay me $500 a video to make it about their company. Obviously, I had to say it in the video, that I was getting paid. But that was like the heyday of my YouTube life, is when I was working with companies, because I didn't even make that much a month from YouTube. And for one video I was making, and that kind of shriveled up. There's not that opportunity anymore. But you got a sponsorship with Moomoo. They contacted me. Is it just so if somebody uses your code to sign up for Moomoo, a brokerage account?
Yeah, correct.
No, I mean, it makes sense. I've had companies contact me for those things. The thing is, it's so rare that someone actually signs up. And I'm not saying
I looked at the offer, and I mean, it starts with, would I sign up? And if you're going to pay me 8.1% on cash for 3 months, okay, that sounds pretty good. And then there was other incentives, like they give you 15 free stocks. Like, well, that's pretty awesome. Darn strong. I'll take the money and I'm like, okay, I'll put it out there and see how many people sign up. I have had some signups, but I'm not really pushing it. My channel's like interesting to have, but I'm not expecting to make money at it, any significant amount of money. We'll see if something else comes up out of it, but I make money from my stocks and my bonds and my real estate and my crypto. And I get inspired, because I engage with really good investors who ask me really good questions, and it makes me rethink and think over my investments, and I get better and stronger out of it.
Yeah, no, and it doesn't cost you anything if you to mention a sponsor or to put it doesn't cost you any money. So, and sure, it could lead to things. I think Simply Wall Street gives me like $30 or $50 if somebody signs up that uses my code. I think I've gotten 2 signups, but I use that service every video, so I might as well. But I don't promote it anymore. I think it's in my comments, but I don't actively.
Yeah, I've done what you're doing. It's kind of like it just takes me out of my zone. I just want to talk about if I'm talking about a company, I want to talk about that company. That's the fun part of it. Or if I'm talking about a set of companies, like I did a video on Dow. The Dow really performed well over the last month. The Dow-based companies, there's 30 companies in there. So I did a video on that's releasing in a couple of days. I'd rather just talk about the content, and the promotions aren't that important to me. So I've just started skipping them. I'm like, it's in the comments. If you like to sign up, it's there. But
initially, when you get these companies contacting you're into it, and then after a few weeks, you kind of just it's in the back burner. It's not really, you don't talk about it as much. I guess it's kind of well, the marijuana stocks. So marijuana is going to change from cannabis to Schedule 3. So it's going to move from Schedule 1 to Schedule 3. Is that?
Yeah.
Yeah. It's going to go from Schedule 1 to Schedule 3, which is a big deal, because Schedule 1 is really hardcore drugs like cocaine, and I think meth and heroin. So it's in the same category as those drugs, which is just crazy, right? Because marijuana, although I don't enjoy it at all, actually, and I don't promote it, but it's definitely not going to do harm. It doesn't kill people. It's not. Alcohol is much worse than marijuana in terms of the amount of people who've died from it or had accidents. But it's still not going to be legal on a federal level, even if it's Schedule 3, right? So it's not going to.
Well, it really so a couple of things I'll say is, first, I was really surprised as to how poorly cannabis stocks have performed. I thought they would have been doing better from a performance standpoint. You buy a stock and it appreciates. I think they've underperformed big time. But put a period on that. If they change this, like what you just cited, it really helps those companies, because right now I think they're banking. They don't bank with traditional banks because they're not allowed to. Because they're.
Can you keep talking? I'll be right back. 1 minute.
Sure. They're deemed to be illegal federally, so you can't go to Chase and open an account. They won't allow you to. So the cannabis companies are then really accepting cash at their locations predominantly. I think that's the only way. Maybe they do a little crypto. And then they have to pay for all the security around cash. They have to transport the cash. It's a really inefficient model. Whereas if they are deemed to be one of the lesser risky controlled substances, and they can get banking, and they can get all these financial services that businesses depend on. They can accept credit cards, all that good stuff. Now we're talking greater efficiency, greater profitability, and probably the ability to grow faster. So the change should help that industry, and it should help cannabis companies become more profitable. Maybe that'll be a catalyst for it to have these stocks rise. But again, it was a big surprise for me. I thought cannabis companies would be making a lot of money. And the reality is they haven't, and their stocks have not performed all that great. The other thing too is like maybe when they change this law, maybe some of the traditional companies, and I'll tell you an interesting report. The wine business, and I know this because I have clients, I'm a software professional, and they've seen wine sales decline, and it's having the adverse effect to cannabis sales. Once cannabis became legal, wine sales began to go down in the same proportion that cannabis began to grow. So I could see that once cannabis is deemed to be completely kind of mainstream, maybe some of these bigger companies that are into spirits and stuff, they are big alcohol sales kind of oriented company, or maybe even like Altria, they acquire some of the cannabis companies. So acquisition targets would probably come out of the gate if they change that law.
Yeah, I think that's one of the bigger opportunities is that these cannabis stocks, although there's definitely demand for cannabis, I don't think they have the resources as like British American Tobacco. Those companies not only have tens of billions of dollars probably in cash, but every single month they're generating hundreds of millions of dollars of cash flow. So they just have a ton of money. So they can gobble up whatever, because they want market share in cannabis if it becomes legal. It is legal in Canada on a federal level. So
yeah, I'm familiar with that. And it'll be good. I don't touch cannabis, so I don't really care from a consumer level, but I think I'm more of the let's get rid of laws that are just like a bunch of paperwork, and it really slows things down. It doesn't really have a social effect. And cannabis has been enjoyed by people for 50 years, and even though it's completely illegal. So get rid of laws that really just don't work, and they're just a costly item for the government and everybody that's involved.
Yeah, it's like the Quag said, they kill these companies, they penalize them so much. Same thing with tobacco. Like they made cigarettes so expensive because of all these tobacco companies, they have to pay not only regular taxes, then they have excise taxes, which is like additional taxes only tobacco companies and gambling companies have to pay. So you get penalized that much more, but they're still making money hand over fist, even with all these additional fees, which is crazy. But I'm saying if you want to invest in a company, find a company that has products that are extremely addictive, like the iPhone's an example. But tobacco, it's so addictive. That's your best customer.
Facebook's pretty addictive, and Instagram.
Definitely. Yeah. I don't even go an hour without checking Facebook. Every I'm always checking it. It's just habit, see if anybody liked my picture or whatever. And it doesn't take me. It takes me a few seconds.
And I think Amazon is quickly becoming like Amazon Prime. It's a new addiction, man. People shop on Amazon like daily. And I bet you if you wanted to torture a daily Amazon shopper, take away Amazon for a week and they'd be really tortured.
Yeah, that's so true. It's like some people don't even if they're not buying something, they just want to go on there and look at stuff. It just gives
shop
them
around. Like, oh, this is a good deal. Oh, that's not a good deal.
It's but I was looking at Amazon earlier. Did I save it? They're going
to announce on Thursday, and I expect they're going to announce, good news. They're going to do well, but they're just their price so high, man. I owned Amazon and I sold it late 2023.
I like Amazon. I think they have I'm up like 60, 70%. I bought a lot in 2020 2020.
Good.
But they have an operating loss in e-commerce.
Correct.
Can you make, like, in North America, revenue of 77 billion, operating expense of 76 billion. So they just have a small $900 million positive operating income.
Yeah.
In North America. And then international, they have an operating loss. So they lose money by running their e-commerce platform. All the profits are in cloud.
Yep.
$5
Their
billion.
infrastructure business. Yep. Yeah. My worry about Amazon, I think they're one of the best companies on the planet. My 20-year-old son just finished a 2-month internship at Amazon. He finished it on Friday. And that was really cool that he did that. Now, my worry is they're in so many different types of businesses. At some point, it's just not going to work. It's been proven over and over and over again where businesses diversify too far away from a core, and it just doesn't work. And Amazon might be the first company to ever do that, but if you look at their e-commerce business, and then you're you're a hyperscaler, those businesses are very different. And then you're a movie studio and you're doing video streaming. It's like, man, at some point that's going to all kind of create, maybe if all those businesses align in the wrong direction, that could really hurt the company. And at some point, I think they need to start selling off some of these businesses that are not focused on the key business that Amazon has, or maybe they split up. I know that's been a thought that other investors have had, that, hey, you should spin off AWS and create its own company and keep the e-commerce business separate from it.
Right. I see it as a loss leader, e-commerce. It's just to build their customer base. But this is an income statement item, operating income. They have, in terms of cash flow, it's a cash flow positive business, and you can see that.
Well, look at free cash flow, because my memory tells me that it's kind of up and down, chart for free cash flow. They've had a couple of really good years, and they've had a couple of really bad years.
Look at first quarter of 23, operating cash flow of 5 billion. First quarter of 24, 19 billion.
Yeah.
So
you see, and if you look at CapEx, and you'll see that 5 billion operating cash flow year ended up being negative cash for that quarter. See that?
Yeah. Well, they did have, they're investing enormous amount of CapEx, but look at their free cash flow in 2024. The trailing 12 months is 45
I'm
billion.
with you. It's just, if you look at Apple, Microsoft, Meta, Alphabet, they do just as much cash, and they have a smooth upward chart. It's very consistent, and you get a premium if you could be very consistent and very predictable, where this, as an investor, kind of scares me. I bought more shares of Amazon in that dip. I mean, it was kind of a logical thing to do, because I thought they were going to rise, but they could have another dip like that, and I think their stock price would suffer. Because again, if you compare, this is a $2 trillion business, I believe, market cap. If you compare it to its peers up in that valuation, their peers are nice and smooth. Nvidia being different. Nvidia is kind of just a hockey stick right now. But if you look at the others, Apple, Microsoft, Alphabet, Meta, even Eli Lilly, very consistent high free cash flows. And to me, as an investor, I'm like, okay, that's predictable. I feel comfortable that they're just going to keep growing that free cash flow, where Amazon 2 years from now could be like negative cash again. And I'm like, oh my God, stock's going to tank.
Yeah. Amazon there's more kind of one big time items, like a lot of those. So it's a little more choppy than these other companies. This is Microsoft.
See how smooth that is?
Yeah, because Microsoft is kind of like it's been around a lot longer than Amazon, and it's a little more reliable and consistent their numbers. But yeah, no, I see what you're saying. It does cause you to pause a little.
I still think Amazon's like one of the top 5 businesses on the planet, right? There's, from a business perspective, I think their business is awesome. I think their ideas are great. I just think they're in too many businesses that are different than one another. That's my, like Microsoft is in businesses that make sense. Like they started as a PC software business and they grew into the enterprise, and then they grew into the next thing, and then they grew. Now they're a big hyperscaler. That makes sense because they're a software company. And so everything kind of makes sense. You're kind of assembling this big, massive company with Lego pieces that are all the same color. Makes sense. But when you have Amazon, you're like, these businesses are very different. Why did you put these businesses together? They were even in healthcare. Amazon was in healthcare, and they got out of healthcare recently because they crashed and burned. They're like, oh, we can't figure this thing out. And healthcare has a lot of regulation, and they just didn't like that. So they got out of it, and they sold off that business. Amazon's even a grocer. They're in a grocery business. So explain that one to me. It's like you're a hyperscaler that sells groceries. You sell tomatoes and you sell GPU, runtime.
They're like the online type Walmart. Like Walmart changed. Like you can have like a small grocery store where you sell a lot of stuff, but it's usually a little more expensive. You can sell like it's more specialized, like a butcher, specialized meats, or you can be Walmart. You do everything. And then that's what Amazon did. Amazon is kind of like Walmart, but they took it online. And some companies just specialize in one thing. Other companies do everything. But it's hard to perfect everything. But if anybody has gotten close to it, it's Walmart or Amazon. They've gotten close to perfecting everything. Obviously, it's not perfect, but it's pretty good. But Barbacoa says it perfectly. Amazon moves with their ratios. They move right along with their price to cash flow. It doesn't look expensive. So you got to look at like valuation. Like you can't say, oh, because they had $100 billion of operating cash flow. Operating cash flow is a good stat to look at too, because there could be like, if you're looking like at like a Meta, and it might, when you look at free cash flow, it could be low in certain years because they just dump so much money into the metaverse. Right. But if you look at operating cash flow, it should give you a better sense because that's the actual cash running their day-to-day business, not including all the investments into potential future business. Mm-hmm. But look at Amazon, $100 billion of operating cash flow in the trailing 12 months. I think they figured it out. I think this dip here is they were getting squeezed a little bit with inflation and margins, but they adjusted. That tends to happen. $100 billion. Apple's probably higher than $100 billion. That's just crazy.
Apple. And talk about cash, man. It's pretty incredible how much cash Apple produces. It's
Apple,
pretty insane.
They're north of $100 billion. God. They've been $100 billion since 2021.
So a lot of businesses don't even have $100 billion in revenue, and they're big businesses. These guys, Apple produces it in cash. It's like freaking nuts.
A lot of businesses haven't accumulated $100 billion in revenue since they started from day one, and they've been around 50, 100 years. That are billion-dollar companies.
Impressive.
That's why I'm just saying.
One little factoid, way back when, this is like year 2000, people may remember that Apple was bankrupt and they were bailed out by Microsoft because Microsoft needed a competitor. They were going out of the antitrust kind of era where governments were saying, oh, you can't run that monopoly. And they needed Apple because they had a separate operating system and so forth. So Apple was pretty worthless roughly 24 years ago. And then they got off the mat and, reinvented the smartphone, and the rest is history.
Oh yeah, that was a game changer. But Barbacoa, another good point. He's kind of like saying what I'm thinking. Real data should be choppy. If a number is super smooth, that implies numbers are being massaged. That's exactly what Bernie did. Bernie Madoff, a smooth 20% annual return for all his shareholders. Everybody's happy, but it's not possible. And I worked at companies, and they were like, "Well, let's not book the revenue on February. I mean, on March 27th. Don't put the revenue in. Wait till April 3rd. Or if we're short on revenue, that order that's going to come in next week for April, book it for March, because we want to hit our numbers. And then we'll worry about being short next quarter." And that's what companies do.
Maybe, but I'm gonna, and we don't have to talk about it at length, but I don't agree with that in principle. And the reason for it is this: so in general, right, the people run these companies, first, are really smart. Second, they have so much to lose. Third, just about every fraud case has been proven. So you're sitting there going, hey, I'm a CEO, CFO. I'm making, I don't know, $50 million a year. I've got a net worth of 400 million. Hey, let me screw that all up by just making sure we don't have a bad year. Instead, I would think that a rational person, right? There's probably a few exceptions, but most rational leaders of these companies are like, no, I'm not going to personally, these officers have to sign off on these financials. If there's fraud in those financials, those officers face jail time and they face massive fines. And personally, they take a huge hit. Bernie Madoff was a hedge fund manager that really didn't even register his hedge fund. So he did everything completely off the radar, and the SEC let him get away with it. But that's a separate issue. If we look at financials, I do believe that financials are presented materially accurate. Now, I agree with you that some companies might, maybe if they have a great year, they might do some accruals to kind of bank some expenses in that current period, because they're like, hey, let's put the money in the kitty, because maybe next quarter isn't going to be as good, or 2 quarters from now isn't going to be as good. So let's kind of bank some of this good stuff so we can come back and use it. I get that, but that's not materially that's big of a factor. I think in general, I wouldn't walk away with, I would say that I don't believe that financials are misrepresented. I actually believe that they're presented correctly. I do think that some ratios are noisy, and I don't like looking at them. I like what Charlie Munger really looked at cash flow. He believes cash flow tells you the most about a business. So I believe in cash flow. So that's what I would say about that. But
no, I definitely don't. And Barbacoa said again, he's like reading my mind. I'm not saying they commit fraud. Very few companies commit fraud. Bernie Madoff committed fraud, but I'm just saying some people like they'll book the revenue the following month, or but they can't obviously book fake revenue.
We were comparing Amazon, who had 2 years of severely negative cash, right? The 2 years of negative cash for Amazon were, net free cash were 21 and 22. They were negative cash in 21 of 14.7 billion and then 16.8 billion. And when you compare that to like Microsoft, who really never really had negative cash, I think we're kind of establishing a perception that, well, Microsoft's probably like cheating, cooking the books. And I would never agree with that. I'd be like, no, I don't. No, they have too much to lose. All those people would have too much to lose.
They wouldn't. No, I don't think fraud is definitely not. Most American companies, no. But I'm saying Amazon doesn't have negative operating cash flow, which I think I think if a company is investing a lot into CapEx to bring their free cash flow negative, that's a good thing. But if a company has negative free cash flow because they have negative operating cash flow, that's a bad thing. And Amazon never had, well, probably like 15 years ago might have, but even in their worst year, they had positive 35 billion, in the past few years, positive 35 billion in 2022. And the only reason they had negative free cash flow was because they just were investing for the future.
Yeah.
And it paid off.
I agree. I agree with you. So I start and finish always by saying Amazon's a great business. And
yeah,
I would just say that some businesses like utilities, I hate utilities because they have to put too much CapEx into their businesses. They're almost having to rebuy their business every 5 years. So to me, it's not a good investment. As long as Amazon doesn't get in the habit of, we always have to put in so much capital into the business that it's almost like they have to rebuy the business every couple of years. As long as they don't get there, I wouldn't be worried about it.
So you're saying Amazon a spike from COVID, the cash flow decline after the lockdown was over. Well, I didn't realize that was the case. I guess that makes sense. They had let's look at.
But I know one thing they did, which was Amazon always impresses, but they changed their logistic strategy where they would have more traditional kind of footprint of warehouses. And they said, no, we're going to change it. We're going to have these mega warehouses. And what we want is 1 or 2 day. We want every single customer in the US to be within a 2-day delivery of one of these big warehouses. And they have 5 or 6. And I think that was a massive investment to change the logistics strategy. It's impressive that they were willing to reinvent the business and do that. And I think that's where a lot of the capital ended up going, because they had to build these massive warehouses and everything that comes along with it.
Okay. I didn't realize that one. But it's hard to know exactly because there's probably like 100 things that go into these numbers that can move the needle. Obviously, like things like that come up, or COVID things come up. But when you go back, a few hundred feet and you look at it from this level, it looks like exactly what I say when I do videos. They're putting a lot into CapEx for future growth, but who knows if it'll continue on this trend. But I see, a lot of potential in Amazon lately. I've always saw potential, but lately I see more value in Amazon than I do in Apple and Nvidia. But we'll see. I don't know if that's the case.
I agree with your statement. If I was forced to invest, $10,000 in one of those three, it would be with Amazon. I think that, and I'm shorting Nvidia, so disclaimer. I think Nvidia is wildly overpriced. I'm not an Apple. I think Apple at best is fairly priced, and I'm really concerned about their future. It's a one-trick pony. If that iPhone, if sales start declining, look out. If the next paradigm of how we interact with our mobile device changes, I think the iPhone is done, and so would Apple be. Apple would be done.
Yeah. It's they picked a great product, and they totally took control of that product. They tried to do the same thing with the EV that didn't work, which is kind of telling.
But they're not. One thing that is one thing that I would point out is Apple is not the market share leader in smartphones. The Android operating system sells. There's more units sold with the Android operating system, but the iPhone is sold at a premium with better margins. So, the Android, like my mom has an Android. She's 88 and she can't afford much, but she can afford an Android. And I use iPhone because my family uses iPhone. I'm probably going to switch to Android because I'm a Alphabet stockholder. But the devices are almost identical. They do the same stuff. It's just one's like sold less expensively and the other one's sold at a premium. Is it always going to have that premium? I don't know. We'll see.
Yeah. Yeah, you're right. I think I saw that and I totally forgot. Yes, Samsung has more sales.
Correct.
But the iPhone, I feel like it does everything for me. Like I don't need anything else in my life but my iPhone because it can be an alarm to wake me up. I can browse on it.
I'm with you, but the Android does everything too. Like it does exactly what the iPhone does. And it's not like the iPhone is the only one that can write emails and the Android can't. It's like, okay, that's game changer, competitive advantage. It's like they do the same thing, but the iPhone has the brand, people, your iPhone is part of your identity. Oh, I use an iPhone, I guess. There's a lot of things that come along with a brand. I'm not going to deny it, but we'll see. We'll see what they haven't been growing. So that's a fact. Their unit sales, Samsung is super strong. That's another company like Amazon. They're into everything, but I think I'm not in Apple. I made a little bit of money in the last 6 months. I bought it in their trough and it rose and I sold it. Nice little swing trade and I got out of it, but I wouldn't be in it for the long haul. I'm afraid of their strategy.
Yeah, it's
year-over-year change. Look at that column. Negative 9.6%. I'd be freaking out.
I know. It's their number one product. I think it's like 70% of their revenue.
The other thing, like if you look at cycles of companies, products become cash cows toward the end of their useful life because you don't have to put much more money into R&D and building out markets and expanding. Like we just talked about Amazon having to put so much money into expansions, and you're seeing that in Apple. You're like very high cash flows. Great. Why? We're not investing much in the business. Why? Because we don't have any more growth. Well, why is that? Because we already sold an iPhone to everybody that has it. So I think that's also kind of a worrisome scenario, which is, Microsoft, on the other hand, they came out with their hyperscaler business just more recently, like 10 years ago. And that business is growing. And Alphabet too, their hyperscaler business, that's relatively new. It's like maybe 7 years old. That's growing. And so is the Google search business. So those businesses continue to kind of like expand logically and have these growth businesses within the business. So they have their cash cows and then they have these growing businesses that make sense. Apple's not doing that. That's a real big weakness to that company.
Yeah. Somebody said Samsung. I don't think you can invest in Samsung, right? Is there a...
No, you could. They're a Korean company, but you can buy shares. I just never figured that it's worth buying, but they're just an impressive company, right? Oh, is it private?
No, I think it's only traded in Korea. I don't see
there's no ADR in the US.
I can't find it. Does anybody know the ticker for Samsung? Because I can't find it. I guess that makes sense because I never really saw it, and I know it's a big company.
Try SSNLF. SSNLF.
That's it. It's on the pink sheets. 300 billion market cap. So I guess if you want to trade OTC, that's how you do it.
I don't know what that means. Can you explain that over the counter?
It's
and
just
between a mainstream stock and over the counter.
It's still a publicly traded company. The one big difference is there's less regulation. Like you're not as required to submit the quarterly 10Ks and 10Qs. and it's less liquid, so there's less buying and selling activity, because a lot of brokers, I know E-Trade you can buy OTC, but some brokers you have to get approval. Like Robinhood, I don't think they trade OTC stocks. I think that's pretty much it, right? The main thing is just less regulation and less liquidity. And it's a cheaper, because it's expensive to trade on a major stock exchange. I forgot how much it cost, but it's not like.
Yeah, I really liked Nintendo, and this is maybe going back 9 months ago, maybe a year. They're a Japanese company that's traded in Japan. And, it looked great, but I had to pay like $50 a trade. And there were other loose ends that I was like, man, I love the company, but I don't know that I want to get into that. Because I thought about okay, I get in and I want to get out. Well, there's going to be reluctance from investors that want to buy Nintendo because they're going to be feeling like I was feeling, which is, I don't want to pay extra fees and loose ends. So that kept me from buying Nintendo.
Yeah. No, I remember when I was trying to buy a stock OTC, it kept giving me all these warnings, and then I'm like, I don't even want to do this anymore. I feel like something's gonna go wrong, because it's a risk, because it's not as regulated. So there's just more chance of you losing money or not even being able to find someone to buy it, because
right.
It's kind of like if you want to sell your home, it's not like you have 100 people like, okay, I'll give you money right now. And even if you find someone, it takes like a month or two to go through the closing process. With a stock, it's literally blink of an eye. You can sell it, but not OTCs. Sometimes you can sell it or even buy it. Companies can jump from generally OTC. If a stock trades below $1 for a certain period of time, it might get delisted and put on OTC. But even if you own a stock and it becomes delisted, you still own the stock. It's still valuable. It's just maybe less people kind of like willing to buy it than before.
Yeah, it makes sense.
Companies can jump from OTC to standard stock exchange as long as they meet. And it is a headache, because if you want to be listed on a major stock exchange like the NASDAQ, you have to hire somebody to just do that. That's their job, to just do the paperwork, complete the filings, the 10K to 10Q. And if you have a small business, you might not want to hire, pay someone $70,000, $80,000. Yeah.
But I mean, we talked about two massive businesses, right? Samsung is massive. They should have plenty of people. And then Nintendo is massive. They've been around forever.
Yeah.
So,
those are.
I think that that's one of the guardrails that I put on my investing is you have to be listed publicly. If I'm going to be involved in a private business, I'm going to be one of the founders or one of the people that are running the business, because I just think there's too much risk there. Private equity goes into these companies and buys them and stuff. So that's I think there's a lot of credibility in the fact that they have to announce their earnings in the US every quarter. I do buy some stocks that are foreign, like in Europe, and they only announce twice a year, so you have to wait, and I'm comfortable with those two investments. But other than those, I try to stick to, okay, there's confidence in the fact that they're traded here in the US.
Oh yeah, it's really no risk. Not no risk, but the risk is the company, whether they can make money. But there's a lot more manipulation on the pink sheets than on a major exchange. So, I mean, it's not likely that, but there is definitely that chance.
Go ahead.
No, I'm just saying it's much more safe to buy a stock that's trading pink sheets than to buy a stock that's not. That's if a private company, you have no idea what you're getting into.
Yeah, agreed. Well, next week is going to be a huge week of earnings, man. It's Microsoft, Amazon. You have Merck. Who am I missing? Meta. You have some big hitters. I think next week if you see any weakness, I think we could drop a lot. But I think all those strong businesses should come in with positive earnings.
Yeah, yeah. I think the hard part is not if a company hits their earnings or misses their earnings, but like, which is, obviously that's important, but also if you could identify stocks that are, because sometimes the earnings is already priced in. So when a company hits their earnings, the stock actually goes down. And sometimes
Alphabet.
Yeah, it happens all the time.
Like they grew their revenue 14% and they're a massive business. I mean, Alphabet's huge. They grew 14% and investors found a reason to sell off. And the stock sold off like more than 8% since they announced. And I'm like scratching my head going, 14% growth on a business that size is pretty damn good. What happened? So I think you're onto something, that maybe there's a trend or a market sentiment that, you know what, we've already priced so much favorable expectations into that price that unless they totally blow it out, we're going to sell off.
And that's what happens a lot. And it's really hard to figure out. Like the 3 months is a time frame between earnings because they report each quarter. So like, who is this? This is Nvidia. So they went from 88 to 135 in mid-June. This is kind of probably a bad example, but like, if you think a company's going to beat earnings, sometimes you can't just wait for them to show their earnings. You have to buy it well before, sometimes 2 months before. And if other people have the same idea as you, even if you're right, you still lose money because it's a sell-off. Because if investors thought they were going to report 50 billion in revenue and they reported, they did hit that 50 billion, and then there's a big sell-off because people want to take in their gains. So it's like, it's
I've been
complex
with Nvidia. I've been reading a lot of Reddit, just to see, it's very what's the right term? It's a few data points among the whole sea of available data, but I'm seeing more and more comments of Nvidia stockholders just taking the money and cashing it out. I think they've done really well. They're cashing it out. This
is the time to do it. I don't think, because it was kind of like my friend who had Tesla, and
they had a brutal week.
Yeah, they've been getting killed. And I feel like I was helping him, but his cost basis was, I think from 2018 or 2019, he got it at 50. I think this is stocks with adjusted, so it's hard to tell. And then he went from 50 to like 300. And I'm like, you got to sell. I mean, this is just not it's not worth what it's worth. And then he went up more, and then he was up 10x. And I'm like, I felt stupid for trying to give him advice, but now it's coming down. But he's still not going to sell. No matter what happens, no matter what. But he's up. He's up a lot.
I believe that it's a lot harder. So it's a lot harder to determine and make a decision to sell than it is to make a decision to buy. And I think emotionally, psychologically, all those factors that come in, it's just much harder to sell. It's almost like you have to almost predefine your exit strategy and really determine that on each stock, because you can, for example, TSM went super high and then it crashed down in 22. Now it's going back up. Well, if you don't have guardrails on your exit strategy, you could have lost a lot on TSM. You would have built some of it back up. I don't think it's gotten back to its original stock price, and you're just going to be riding a roller coaster. But you'll feel a lot better if you sold TSM at the right time and then came back and bought it at a huge discount, like 80% discount from the previous high. So I would say that, if there's no discipline in investing, I don't know. That's how I see it. Is every investment in my portfolio has to earn its position into the following year, so to speak. I just don't blindly buy a company and own it forever.
Yeah, no, I have a pretty simple strategy, but I pretty much hold forever, not forever, but as long as I can, unless I lose faith in the company. But I'm learning all the time. Like, so I think I made the most money, and I used to think like, I want to make, $10 million on a trade. But I feel it's just playing the lotto. It's so hard to do that because even I couldn't drop like $100K into Nvidia. I guess I could have, but I don't know if I would have held. It's just to like. But all I'm saying is I made the most money, not from picking stocks that were unknown and they were cheap stocks. The most money I made was picking really, really good stocks that were still expensive, but they had pullbacks. Like I made the most money on like Meta when it was already like $1 trillion company, but I got it at a lower price.
Right.
It's not like it was unknown. It wasn't like there's a new company. It was already extremely established. Same thing with Berkshire Hathaway. It's well established. I just happened to pick it up and I'm just holding since 2017. I very rarely made a lot of money on a stock that no one knew about, that I only knew about. Like most of the stocks I made were just really, really good companies, and I just happened to get in a good time.
It's all about like, so there's a term, you only have to get rich once. Have you heard that term in investing, which is once you've amassed enough money for you and your family, are you going to bet it all again? Well, I'm sure some people would, but I wouldn't. And I don't. Now, once you get to that point, it's like, hey, I want to make more money than I need each year from my investments. And that's really my mindset now. Cause I'm 55. So I've worked for some time. I've amassed, for some time. I've invested. I took some risks early on. Some of them were complete failures. Some of them were super good winners. Do I want to do that again? Maybe, but only with a portion of my net worth. I would never put it on the line to kind of say, oh, well, I got this much. I think I want to multiply it times 10. I'm like, no, man, I'll play with like maybe 10% of my portfolio, 20% in high risk.
Yeah. It's it's really hard. Like you can't predict this stuff, and your strategies change. Yeah. It's more psychology at the market than like, like Buffett, you said earlier.
Buffett made extreme amounts of money buying stuff that was established, but it just had another huge run. Apple being a genius move on his part. Coca-Cola. I mean, you can go back and look at the businesses. Now, his Paramount stake, he did exit that stake and admitted, hey, that was a mistake, which I love Buffett because he's pretty honest, man, for the most part. I'm sure he keeps some things away from us, but I mean, for him to come out and say, hey, I lost money on Paramount, it was my fault. That was so huge of him. I just like him even more because it shows that even one of the best, man, buys one and it's a dog and he gets rid of it. He has an exit strategy. The whole concept of Buffett buys and owns forever, that just got broken, everybody. Take notice. He saw that business was a dog and he got rid of it.
Yeah. You can't, you go into a stock thinking it's a great company, but things could change, like people who invested with Madoff, like I'm sure they didn't like think he's running a Ponzi scheme. But you can't predict the future. But his track record, Buffett's track record is pretty solid.
He's getting out of Bank of America, so I'm sure that's freaking out Bank of America stockholders.
He's been selling Apple too. He sold like
not in massive quantities. Like Bank of America, he's kind of getting out of that position. He's selling
Really? I didn't realize
big stakes of his Bank of America position. Bank of America has done well for the past year. Apple, I agree with you that he's selling, but I think how much Apple does he own in billions? Like
a
50
lot. Billion. Is it 50 billion? Something like that. Well, it should be here.
And he's chipping away at it. Like the value, there it is,
135 billion.
Oh my God. And he chips away at it, right? Like he's selling 5 billion, 10 billion. Well, it's going to take a while. Or I think the B of A stake, he's selling pretty good portions of it. And American Express, I've never liked American Express, but maybe it's because I have to use the American Express corporate card. I hate the whole American Express experience, but that's just me. Coca-Cola, I own Chevron. I've owned Chevron forever.
Huh. Comcast. Somebody asked you if you still like Comcast.
Yeah, I changed my tune on Comcast. I thought it was undervalued, but I came to realize more recently that they just have too many risk factors. One of them being that I think the streamers are basically cleaning up, and all the legacy media companies are going to have trouble with that. Second, their theme parks, right? They operate big theme parks. I'm not in love with theme parks. I don't think they're great businesses. So in general, I decided I'm going to get out of Comcast completely, and I'm going to put more money into Alphabet, which does have a piece in the media business, which is YouTube. We're on it right now. And I'll really concentrate my investment in Alphabet and Meta, which you could argue is similar company, but different. And just kind of in that space, I got enough with Alphabet and Meta. Those are my two biggest stocks right there. I've got a lot of money riding on those two.
Yeah, it's two good stocks to. Yeah, but they say like every 20 years, like the top 10 stocks are totally different. So if that's the case, I might lose a lot of money because I have a lot of top 10 stocks.
Well, I think that, I think Alphabet has a lot of upside. I think the Alphabet business, they got a lot of good things coming, and they got a lot of good things now, right? Their search business is awesome. Their AI business, you can't say they're not part of the next wave of that era. I think they have a pretty good opponent in ChatGPT, but I think their AI business is really strong. Their hyperscaler business is growing. Their YouTube business, YouTube is now the number one streaming app on the planet. Number one. It beats Netflix. It also makes more money than Netflix. So that's pretty damn impressive. But if you look at their stock, it's not super crazy. Like Nvidia obviously takes the cake on how high it's gotten. But you look at all the big large caps, Google's stock rise is somewhat like rational and kind of toned down. Meta's just screamed up in 2023. Alphabet didn't. It's just kind of had a nice steady rise to the right. Having said that, I think Alphabet's a pretty strong business, and they have a self-driving car business, which they've been working on for 10, 15 years, and it's real. It's not just Elon Musk blowing his horn going, hey, I'm going to have a self-driving car business. Yeah, you're going to start and you're going to have a 10-year catch up to Alphabet, which has Waymo. So they just have, I think it's a company that has a lot of awesome businesses that all make sense. And that's why I continue to buy. On the pullback this past week, I invested probably about $2,500 in Alphabet, probably about $2,000 in Meta on Wednesday, Thursday, Friday.
Yeah, it seems like you can't go wrong with these companies, and I hope that stays that way. But I think there hasn't been. Well, there was a sell-off, I guess, but Meta had a huge sell-off. People were losing faith to Meta, but Google. I wonder if Microsoft is more of a straight line than Alphabet. I think.
I'm going to admit to one of my biggest investing blunders when you show the Microsoft stock. So I owned Microsoft, so obviously the dot-com bubble burst and stocks sold off. I owned Microsoft from 2002 until like 2014. And you see why I'm like, oh my God, I'm such an idiot.
I know it's so easy to look back and like, oh my God, it's so obvious. But it'll never end. Like I was like, oh, if I just could have saw Nvidia, I could have had $100 million. But like
now I have a good excuse. In 2012, I invested big in 2010, 2011, 2012. I invested big in real estate. So I needed to liquidate. And that ended up, I took call it 400 grand and turned it into $2 million. So that turned out to be okay.
Yeah, but how would you know if you could have put 400 grand and turn it into 25 million?
Yeah.
But how would you know that? I mean, it's hard to do that. It's hard to put your life savings into one stock. Now it seems
the Microsoft stock has been super impressive. I mean, look at it. It's freaking awesome. So, oh well. Live and learn. I'm not going to sell my Alphabet stock. I'm not going to sell my Meta stock. It's going to take a lot to sell those stocks.
That's the thing. You can't get upset if you never sell, assuming it keeps going up though.
As long as their businesses continue to just get the Meta business keeps getting better. Their AI business looks phenomenal. They took Threads and they're probably going to put X out of business, which is hilarious. So the Meta business continues to get stronger and stronger and stronger. So I continue to be an investor. Alphabet, I just kind of went on a full-blown diatribe on that. So as long as those businesses continue to get stronger and better, I'm in. And I don't think I'd sell, but that could change in 5 years. Maybe the AI thing changes the landscape and search isn't that valuable anymore, and I'd have to revisit it.
Yeah. You just don't know what the future's going to hold. It's okay. Seems like we're getting only down to 7 viewers. So, have you ever had 100 viewers? Have you ever?
No. On a live stream?
Yeah.
No, man, nowhere near that.
Yeah, I rarely get
in the mid-teens to low 20s, mid-20s on my live stream.
And me too. I once in a while. I think once I hit 100, but it was fleeting. I guess a lot of people jumped on, but then they jumped right off. So didn't really. One day, maybe when we do the monthly thing, maybe that'll catch on. I don't know.
Yeah, we'll see.
Okay, so thanks for jumping on. Thanks everybody for commenting.
Yeah, it's good to be on, Scott. Good to see you.
Yeah, you too. Okay, talk to you soon. Thanks a lot.
See ya.
Okay, see ya.